Hi, everybody. Welcome to the last session of OurCrowd University. The session today is all about valuation. Before I bring on all the speakers and we do the introductions, I think the appropriate way to really set this panel off is really to describe how valuation plays such an important part in venture investing. And it doesn't take a lot to look over the news over the last few weeks and see the debacle that's happened at WeWork, probably the most famous story of current history, about how valuation has gone so wrong. Okay, and when you have such a behemoth like SoftBank that is able to stand up and publicly admit that they got it completely wrong, I think there's a tremendous amount for us to learn. So with that, I'm very, very pleased to introduce my co-moderator is Becker, who is, as of today, working with Lightricks, one of Jerusalem's unicorn companies, but before that has actually been the deal lead counsel with OurCrowd for the last 6 years. Together, we've probably done well over 100 deals and have spent a tremendous amount of time together discussing some of the issues that are going to come up on today's panel. I'm also very, very pleased to introduce to you today Adam Valkin from General Catalyst. General Catalyst is a tier one VC. You know, it's renowned for its success. Adam particularly has also made some tremendous investments in Deliveroo, in Rapid, in Lemonade, and represents the firm not only in the US, but is also responsible for all its European and Israeli investments. So, Adam, thank you very much. As of a couple of weeks ago, it was also seen in the papers that the fund is now raising another $2.3 billion fund. This will be the 10th fund. Currently, the firm has over $5 billion of assets under management. So great to have Adam with us on the stage. Thank you, Adam. We also have Tomer from CropX. Tomer is one of our startups and OurCrowd startups, so he's going to come from the other side of the spectrum, and he's going to really show the founder side of how to talk about valuation and some of the considerations that come into that. So, Tomer, thank you very much. Marc Lesnick from Fortissimo Capital. Fortissimo is a private equity firm. So if you think of investing in the spectrum, on the one hand, you have the early stage stuff. On the other side of the spectrum, you really have the late stuff, private equity, companies like Nur Microprocessing and SodaStream, where Marc was on the board of that company. Is still on the board of that company? Was on the board of that company. Okay, so thank you very, very much to Marc for joining as well. And finally, Yuda Doron, who's here from TPG. He's going to describe some of the investment he has, but he's a prolific investor, really in the middle stage, looking at some growth opportunities in Israel, and very, very well known in the ecosystem. Thank you. Thanks, Yuda.
Thank you. Thank you to our wonderful panel. Can you hear me? So, as Shmuel opened, this valuation question is one that can fail even the greatest at times. And I think one of the nice things about having the sectors represented by different venture capitalists is to hear how each of you address the valuation question. So I think we'll start chronologically, and we'll talk about the early stage companies. So that's Adam, right? You do.
Oh, no, take a mic. Sorry.
Okay. You invest across, but I think of this panel, you probably invest the most in the early stage companies.
Yeah.
So to what extent is a pre-revenue company either a challenge for you or an opportunity for you? Do you see it as a hindrance, or do you see it as a way for the horizon to be dictated more by where you set the valuation?
Yeah,
and I just wanted to say after that, I also want to hear Tomer's perspective as a founder on that.
Yeah, so maybe just a couple more general comments about valuation in startup land before talking specifically about pre-revenue companies. So I think the one thing just to take note of is that beginning of 2020, there probably has never been a better time in history to be an entrepreneur raising money, because there's never been anywhere close to the amount of capital chasing after opportunity. And if you look at the amount of new capital that's entered the market in the last 10 years, it's kind of breathtaking. If you just take Europe and Israel alone, which is a fast-growing emerging area, in 2013 there was probably $5 or $6 billion invested annually in venture capital. 2020 it will probably be 30 to 35 billion, and that's a pretty recent growth. So essentially, what that means is it's an entrepreneur's market. So if you are an entrepreneur with either a track record or a killer team that you put together, an incredible idea, and you've created momentum around your fundraising story, in some respects you can raise money at whatever price you want, as long as there's more than two people that want to invest. So it's very much driven by the market, supply and demand for opportunity and capital. And there's just a lot of capital in the market today. Now, valuations do vary a lot based on geography. So valuations in California, insanely high. Valuations in Israel, insanely high. Valuations in France, insanely high. Why? Because there's either, depending on your view, there's either a large supply or an oversupply of capital in those markets. I think the caution is, if you invest at a 20% or 50% or 100% higher price, you got to make 20% or 50% less money, unless the exits turn out to be much bigger, which does seem to be happening too, which is, I guess, the good news. So that's just kind of my, the high-level comment. I think for for seed stage companies or Series A companies, essentially what we've seen is that valuations have gone up a lot no matter where you are. Seed stage deals 10 years ago were done at $2 or $3 million pre. Today they're done at $10 to $20 million pre. Series A deals used to be done at $5 to $10 million pre. They're now done at $20 to $50 million pre. Size of the rounds have gone up a lot. Series A deal used to be $5 or $10 million. Now it could be 15 or 20. So we're living in interesting times, and I think that it's very difficult to kind of pinpoint how valuation is done, because it's done based on a conversation and side conversations and back channel around what people's expectations are. And the people that have a competitive dynamic can usually get their price, and the people that don't can't. So, I'd say for, what we generally try to figure out is how big, especially when you have a big fund like ours, the real question you're asking is not like, how's this going to go wrong? You're asking if everything goes right, like everything goes perfectly, almost the impossible. Like if you imagine that everything that the entrepreneur thinks could happen does happen, could it be really big? Could it have a huge impact on the world? And will it matter to our LPs? And if it does, and you believe that, then you try do it, even if you have to overpay. We overpay all the time for investments.
Wow. With that, let's go to a company. Here, two. Is it one mic or?
So I think from kind of trying to represent the startup perspective here, even though I've been a VC, I think, more than I was raising for startups. But I think it first starts with the number of founders that are in the company. So many times I see like 4 founders coming to raise money. So they start with 25% of the company each. By the time they're past the seed round, they probably have 15% each. And after Series A, it's 10. And by the time you exit with ESOP and God forbid a small down round, nothing's left. So that's, and then they got to be much more aggressive on valuation. And on the other hand of the spectrum, if there's a single founder, well, don't even stop to think about the valuation. Just go raise the round and get on with your life and start building your company. So I think that's a very important starting point. Now, after that, it's all about tactics and process and how well you negotiate. So typically, you have your own kind of deck of cards in your hand. You know how strong you are coming into the negotiation. I think an experienced founder would typically get as many horses on the race as he can. And now it's all about trying to get the best deal that you can. However, I do caution founders. Many times I see too many founders kind of insisting on squeezing the lemon and trying to get the best deal and getting really fixated on valuation to the extent that they're missing out on great investors, missing out on rounds, and just really the companies just stagnate for a year and a half, just waiting for money to come. And time is not waiting for anybody. So in that respect, I've seen just horror stories of just startups that go nowhere just because of this very basic mistake.
Wow.
Great.
If I can address that, actually, we're, as opposed to venture capital, we classify ourselves as a private equity fund, which is sort of later stage, more mature companies. So we wouldn't invest in startups per se. We like to see companies we draw the line at about $10 million in revenue. because then we know that they have a product that works. And what we do is we don't take technology risk, it's more execution risk. Once they have a product, how do we make sure we can help get to new geographies, maybe buy additional companies and spread it. So there you actually have, it's less of sort of, what the valuation. There are metrics, whether it's EBITDA multiples of profitability, discounted cash flow. There are different models, but no matter what you apply, you still always have a little bit of a gap of what the expectations are of the entrepreneur and the investor. And, we come up with some kind of creative structuring in order to usually bridge the gap.
Yuda, let me ask you a different question. Adam mentioned before that he's happy to pay a premium to get into a deal. It's often said that strategic investors would often inflate a valuation of a company. They're less price sensitive. How do you see that in the market today? And specifically, have you ever cautioned a company about taking a valuation that you think is just too high at this stage for the company? Have you recommended companies that you're already invested in to drop the valuation because you just don't feel that the strategic has a justified valuation? It's just simply too high.
So strategic, yes, they're less sensitive to valuation. They normally do not lead, surprisingly, they don't lead rounds. And basically, they're being carried by the company. They ask the company how much you want, what the valuation, and basically, follow the founders or follow another investor in the company. Strategic has a different objective. Of course, they coming into the company because they want to help, but they basically like to see if they can buy the company in the future. And if, God forbid, they lose interest, then you basically lose this strategic investor, helper, accelerator in the market. Again, there's some other pitfalls associated with strategic. Is one, if you choose one strategic, then the other strategic will try to avoid you if they can. Because, you tie yourself to somebody and the other one will try to stay and pick up somebody else. So that's the pitfall of it. When it comes to valuation, we are very cautious about evaluation. The market, the cycle is still in. We don't know when the cycle will end. I mean, it's not going to end tomorrow, but the cycle will end. And we're very careful about the valuation because I don't know how many of you have been in a downsize or in a down round. We are very cautious. We don't like to have down round because when you do a down round, you basically hurt all the people that came before you. If it's the founders, if it's the angel, if it's the VCs that coming in, and we are very careful about it. I mean, I personally am an angel investor, and I invested in tens of companies, and we are very sensitive, and luckily for us, we never had to go and do a downsize that hurt people. And of course, we are cautious about evaluation. We always tell the founder, and the way we do it is by showing examples in the market, basically in the public market, why the evaluation that they ask is too high, even if we are the investors, because it's misaligned. And actually, we run a process right now. I mean, nowadays, and somebody, gave us over $1 billion offer, and we're trying to get the offer down. So because we know that the cycle going to end, and God forbid you have to go to a downsize or to a down round, and basically everybody get hurt.
Thank you.
Speaking of down rounds, and as an investor trying to mitigate your risk of that, to what extent and this is, I think, I'll pose this to, I can pose this back to Yuda, and then also to Adam and Tomer. To what extent, when you're protecting yourself against a future down round, does the valuation piece play a big role relative to other things like liquidation preference and ratchets?
Yeah, so we like plain vanilla. We like simple. We like alignment because, I've been in investment for a long time. If you don't have alignment, if you don't have the same objective, down the road, you're going to suffer. So we like to have things that are simple with no, covenant or protection. You like to make it simple. Sometimes the founders like to play it big and they want to be a unicorn or even more than that, and they push on the evaluation, and then you need to have some downsize covenant, protection, whatever, but we try not to do it in general. That's basically what we're trying to do.
Yeah, so the difficult thing about our industry is the feedback cycles for success and failure are extremely long, as anyone who's participating knows. You know, you start a company, it takes 2 years before you even raise money, and then it could be like a 10, 12-year journey. Same for the investor investing in the company. So kind of unfortunately, valuation has essentially become the sort of marker for how well you're doing. And there's a huge obsession with valuation marks because it is essentially a indicator of are things going in the right direction. And venture capitalists use it to mark their funds for fundraising. Entrepreneurs use it for stock option grants and motivating employees and recruiting and saying, look how well we've done. In the last year, we've gone from being worth 100 to 300. So if you join now, hopefully we'll be. So it's kind of like a tool of the industry, and it's almost like a drug. People just become obsessed with this idea of getting a high mark. And you can understand it, but it is dangerous for a whole bunch of reasons, some of which have been covered. The thing that goes wrong, and you're starting to see it happen now in this highly inflated market, is as rounds get further and further up towards like pre-IPO, the most disciplined investors are actually the late stage people, like some of the people on the stage, because they actually deal with the real world of public markets, and they know that you can't actually justify paying that, you can't keep, because entrepreneurs would love to say, when we had 10 million of revenue, the valuation was 100. Now we've got 20 million, the valuation should be 200. And when you've got 50 million, should it be 500? But the later stage investors, the growth, private equity, they actually know what the reality is. So they kind of are more sober than the early stage people like us, typically. And reality starts to kick in. So what you're seeing with some of these companies that have constantly raised and higher prices, as they get to the pre-IPO rounds, or the IPO, as we just seen with Casper and WeWork, is they actually can't raise money at the higher price. And then that's when it all sort of comes home. Prediction is in the next year. I don't know when it's going to happen. I don't think any of us know when the cycle's going to end. We probably all think 2020 is going to be phenomenal, but at some point in 21 or 22, these late stage rounds are not going to clear. The deals aren't going to get done, and the down rounds are going to start happening. Because we're talking about down rounds now, but there are actually not very many of them going on in the market. They're like occasional ones. But what's going to happen is what happened in 2001 and 2 and what happened in 2008 is down rounds are going to be a thing. And it's going to be sad because this industry is very much driven by the positive storytelling and everything's up and to the right. So I do think that, in short, it is something that all responsible investors, entrepreneurs should think about. But you got to balance it because you want to do a good deal, but at the same time, you don't want to do something that hurts you later on.
Marc, before I come to you, I just want to define when we talk about a down round, effectively that means the company is raising money at a valuation usually significantly lower than the previous valuation. So you're effectively taking all that previous wealth creation, all that money that was previously put into the company, and you're now compressing it into a much lower value. Okay, so that's where the impairments on the investment come, and that's why investors want to avoid it at all costs, and that's certainly why founders want to avoid it at all costs. Marc, a question for you based on what Adam's saying now. How is this impacting your business? How are you seeing, I guess, the earlier stage companies having the valuations that you can't justify at this stage, right? You see that IPO market is waiting there, but you're obviously capped in when you could get into these companies, and the expectation from the founders, the board isn't necessarily there because you can't provide the growth metric that they would have appreciated.
That was for me, don't
Yeah, yeah.
It's interesting because I was thinking this as Adam was speaking. We are very valuation sensitive because, again, we're not thinking about a dream. A lot of times, especially when it comes to startup companies, it's early stage. You have a vision. The company can be worth $1 billion. It's worth taking a shot at it, and I'll have a large portfolio. We invest in much less companies get very involved, so we're much more risk averse. And maybe I'll just give 2 anecdotes, sure, which will hit the point. There was a company which we thought had a lot of potential, and the founder said, okay, no problem. The company will be worth somewhere between $1 billion and $2 billion in 2 years, and the valuation now is only $400 million for you, right? Like a little shook down the block, right? So we're like, but how do you get there? You have ARR, the revenue of $8 million a year. How are you going to justify a $400 million valuation? But we really did like the business, so we tried to be creative, and we said, okay, we'll get a preference where let's say we invested $30 million, we said we get a 2x preference. So when the company's sold, no matter what price, we get the first $60 million, and then there's a catch-up for the other investors, and then we split it. So this way we have downside protection, so that if the company's not worth $2 billion, but only worth $100 million or $200 million, at least we knew we got our 2x, because that means that it wasn't worth $400 million at that point. The entrepreneur wasn't willing to do that. And we said, well, if you don't believe your company is going to be worth at least $100 million, where you'll get a nice exit and we'll get our 2x, then we're not going to ride the wave for the $2 billion. On the flip side, maybe some of you heard a company called Monday. Actually, we met them a few years ago, and we had a term sheet with them at a $40 million valuation. They wanted $60 million valuation, and we were trying to bridge that gap. In the interim, US VC came in and gave them a $100 million term sheet, and we said, go ahead, take that, it's crazy. And they raised at $1 billion just recently. So sometimes being disciplined means that you miss some of the unicorns. But at the end of the day, we say we don't cry about the deals that we miss. I guess we smile about the ones that the losses that we didn't invest in. So it's a different. I think it's a different risk level when you're dealing in private equity and venture capital.
So let me ask you a follow-up on that. Yuda before mentioned that plain vanilla deals, and Tomer, you said stop squeezing the lemon. Everyone should just rather find the good investors. And here you're talking about liquidation preferences, right? So. How much of your negotiation with companies is on all the other economics, right? The liquidation preferences and the clauses and the control provisions, as opposed to just finding that plain vanilla, company where the deal's just good enough.
For us, a lot of the conversation is always on valuation. In fact, I think in early stage companies, when you sign a term sheet, it's pretty much a done deal. By us, since we're investing in later stage companies, there's a lot of diligence that needs to be done, and we can spend several $100,000 on doing diligence and then not do a deal. So we make sure that we agree on the terms and sign a term sheet before we even really conduct serious diligence. And I would say more than 50% of the time, we end up finding things that weren't the way they were presented, and then we either renegotiate price or we don't do the deal. So for us, it's very important, to know that we have that downside protection, and we try to be creative, whether it's preferences, whether it's an earn-out, meaning if you think the company really is going to do well, so if it hits certain revenue targets, if it hits certain profitability, or even if we're able to get a really good exit, then we'll give you an additional, bonus of tens of millions of dollars, and that way we sort of align our interest. But like I said, we are extremely valuation sensitive, and in fact, within our sort of partner meetings, we have discussions on whether we're being too disciplined. But so far it's worked.
Marc and Yuda, building off of what Adam mentioned earlier, to what extent do you see in your capacity as later stage entrants or investors the role of bridging the gap between that bubble that exists in the private world and the reality of the public markets?
Again, we always look at because we're coming a little bit later than the VC, we always come after the VC. We always have a reference point of the domain of companies similar to the company that like to invest in the public market. So we always put it as a mirror to the founders. Say, that's what's going on. Look at it. That's a reference point. Again, as I said, some of the founders really like to be big and like to have a unicorn. It's important for them. Then you go down and try to protect yourself, and they're willing to do it because they really want to present themselves, and there's some good in it. The one that are more that we can explain and allow why the objective and all the investors have to be more or less on the same pace. We go to the simple non-covenant agreement, and basically we go down with an evaluation. For us to go and put an evaluation that will force us later to do down round is scary. We don't want to do that, again, for us and for the other investor, because we never have done it, but I can give you 10 examples of Israeli companies that have done it, and it's not nice.
Sure. But I think go Marc first and then you, Tomer.
I think we do look at the public markets, but a lot of times, private companies think that they should get the same multiples, and there are various reasons why public companies have much larger multiples, because of all the cash they have. They might be the number one leader in the industry, easier access to capital because they can raise debt and equity. So we still do give a discount to the private sector. Yesterday we had a meeting with a few investment banks. We're looking to sell one of our portfolio companies, and they were telling us that now's the great time to sell. And they gave us this statement, which I was shocked. I mean, I kind of feel it in the industry, but I didn't realize this. They said that the EBITDA multiples, like they say, the profitability multiples of companies in M&A transactions, meaning private companies acquired, over the last 2 years was 50% higher, 50% higher than the average over the last 10 years. And they said, we don't know how long that bubble is going to exist. So, we thought, well, the company's really profitable, it's doing well. If we wait another year or two, we can even, make more money. And they said, you might not get the same EBITDA multiples. So you might be more profitable, but you're not going to get, a 15, 16 times on your profit. You'll only get maybe 10, 12 times. So if you sell now, you'll make more money. So, the market sort of helps us when we sell companies, but when investing in companies, I think people are more conservative.
Thank you. Yeah, so I want to add to what Yuda said, and just I think in Hebrew, or there's a term coming out of the military. It says for every Shabbat there's a Motzei Shabbat. In other words, whatever you do now, there will be consequences. And I think that's true for both the companies and the investors. So the investors, from the investors' perspective, it has to do with what we spoke about before, which is non-standard terms when it comes to liquidation preferences and ratchets and all that stuff. So essentially everything that the investor gets today, the next investor that's going to come in the next round is going to want for that and more. So that's going to possibly backfire. And the same goes for the company when asking for a too high valuation. Like I found myself in the past actually arguing with my board about not going on a too high valuation. I actually try to keep it down and lower because I know that I'm going to have to raise the next round eventually, and that's just going to make it harder for me. So there's a certain balance, and I think both sides need to remain within the kind of plain vanilla, I would say, a range, which makes things much easier.
Sorry. One thing to add, I think sometimes the way to bridge the gap also, I've seen some companies that have decided to take less money now because they say, hey, well, we don't want this valuation. We don't want to get so diluted. So, we'll take less money now, and then you'll see in 6 months and a year from now, we'll hit a milestone, and then we'll be able to raise at a much higher valuation.
Adam, you spoke about the market turning in 2021 or 22, and you guys are doing the right thing, obviously, right? Raising a major fund now to make sure that you're financed for that to happen. Are you looking forward to the market turning so that you could become, a bit more predatory and find in some of these companies that have great technology and value to them that can't raise in other, from other avenues, and you'll be able to come in and take the lion's share?
Yeah, I mean, early stage venture capital firms like ours are not really in the business of being predatory. So I don't think there's anything wrong with having that business model, but that's not really what we do. Like our business is so competitive that we live at the mercy of our reputation with founders, especially in the U.S. where there are hundreds of firms, with lots of capital. We essentially, it's not quite how we are wired, certainly on the early stage side. With that said, we do both early stage as well as growth investing, and I think that there certainly will be opportunity for anyone with capital when prices come down a lot. And I think there'll be a lot of, but the way I see that playing out is there'll be lots of companies that have built scale and have interesting positions in the markets they're in, especially in the SaaS space, but they may have raised too much money relative to the growth rate they have. They may have investor groups that are really tired, and there's opportunity to come in and work with the founders to kind of freshen up, whether that means recapping the companies, just investing more money, potentially consolidating with competitors. Because I think one of the sort of key features of the world that we live in today is that way too many companies have been funded in the same spaces. And this is not uncommon, because essentially what happens in venture capital, and this has happened for 50, 60 years, going back to mainframe, PC, internet, cloud, whatever the wave is, there's some kind of major new platform opportunity. And then there's all the application companies start to form, and more and more capital enters the market, and more companies get funded, each one explaining how they're different to the one next to them. But in truth, when the tide goes out and the cycle ends, it's like, well, do these companies all really need to exist, especially when the customers pull back and aren't spending as aggressively on technology. And that phase hasn't happened yet. But when that does happen, two things will happen. One will be companies will die, run out of money, and investors won't fund them. And the second will be the consolidation phase. So you'll either die because you get triaged out, like the investors pick, let's focus on these companies, not those, or there will be, consolidation where they say, well, you guys thought that you were, you guys thought you were different, but you're actually not that different. You need to merge. Investment banks will make a lot of money when this happens because there'll be a lot of deals happening. And also big companies will come buy up some of these companies, do acqui-hires. So there'll be all kinds of opportunity for everyone. But there will definitely be some kind of price to pay for the craziness that we've been involved in now. But I don't want things to crash anytime soon because we need the public markets to continue like they have for another couple of years so that we can take companies public and hopefully sell some of them. The one other thing I'll say just before passing it on to my peers here is that when you value companies, you can look at like revenue multiple comps and profit comps and gross profit comps and whatever. But at the end of the day, the really big exits that we all are playing for generally don't happen because of revenue and profit. They happen because the companies are highly strategic to multiple potential buyers where the buyers have a lot of cash. And you could look at Microsoft paying 20-something billion for LinkedIn, paying $8 billion for Skype, paying $8 billion for GitHub. You can look at Visa just buying Plaid for $5 billion. All these companies are, whenever you hear about these deals, highly strategic space, and there's only one company that you can buy, and they're more than one bidder. So that's kind of the secret recipe. So when you're thinking about valuation, what you really should be asking yourself is, do I think this is a highly strategic space, and can this company be the one of one? Because if that's the case, then you can sell a company on a valuation scale that isn't rational, and then you can afford to overpay. And a lot of the very good venture capitalists have figured that out. Hopefully I will too.
Yuda, I read yesterday actually that the five biggest tech companies, right, Facebook, Amazon, Google, Microsoft, right, they've spent over the last 10 years on average 3% of their cash balances on acquisitions. That's all. Just 3% of their cash goes to acquiring startups. With that in mind, how do you kind of see the next, let's call it short term, like 1-2 years, and then also like over the next 5 years, if that really is the trend, if it's only going to be 3% in these companies, because I know every startup that I speak to, they have the killer app for Facebook, right? And it's the killer app for Amazon, but Amazon and Facebook apparently are not buying that much. What advice do you give to startups and to founders, right? Because you do a tremendous amount of mentoring as well. So what do you tell these founders that have these killer apps?
Okay, so, surprisingly, those big companies have innovation. In the past, Cisco used to buy innovation from the outside. They continue to buy innovation, but they also generate innovation inside. They pay a lot of money to developers, open, development center in Israel and other innovative places, and basically innovate by themselves. When my advice to founder is, I always look at two routes. One is like a feature set. You build something that is an add-on to Salesforce, an add-on to Facebook, whatever. And the other one is you really build something completely new, like a platform that really can add value from A to Z. And my advice to them, if you do the feature set, you basically have to follow closely to what those giant potential acquisition going to be. And on the other hand, if you try to build a whole platform, it's not enough that you pay attention to the revolution that you're doing with the technology, but also with the business model. You really have to, when you do something that it's radical, it's not enough that you focus on the technology, but let's focus and bring people that can really think about the business model, the thing that outside the technology. And that's what we're trying to work and do with the founders. Remember, we are not starting with ideas. I mean, we have other guys that do it better than us. We always come in a later stage. So we already can see market product fit, we already can see sales, we already can see customer, we can see what's going on within the company and how direct the company slowly writes, do a little bit of zigzag to present themselves, or as an acquisition, or take it till the end to a public offering.
Marc, do you have anything you want to add on that?
I think we're in the process of selling 2 companies now, and there are a number of strategic buyers. I think what's interesting to them is both of them have significant recurring revenue. So I think that also, large companies like to buy revenue, and they know if it's recurring, they're going to be getting, at least a certain high percentage that's going to automatically every year kick in. I think that gives them a certain level of predictability. And also this differentiation. It's that where there is something different about the company. They're sort of a leader in a niche. So I think that's important too. Sometimes not being just another me too, but if you can distinguish and differentiate yourself, then I think people will pay value for it. I just wanted to address one thing you asked about the year, right? I think that's something Adam was talking about. I think 2 things I just wanted to add. One, 2 transactions that we're investing in now are actually VC-backed companies where there are several venture capital funds in the company, and the company's been around for 10 years. Both of them happen to be by chance. One a software company, one a capital equipment company. And the VCs basically came to the end of their life, so they can't put more money in. The company's not a spectacular company, but it's mediocre. It's okay. It's actually profitable. And we believe that with supplementing the management by investing capital, we could turn mediocre into something which is very good. And I think we're going to see a lot more of those transactions as well, because a lot of money was raised here, 10, 12, 8 years ago. And as the VC funds start to come to the end of their life where they can't call capital, so they can't invest, they're going to want to get out, and we're going to see those opportunities. That's one. Number 2, one thing that we're seeing now with our own portfolio companies, I'm usually an optimist, and I still am, but try to be practical as well. And I don't think the market really recognized what's happening with Corona right now. A lot of our companies have some manufacturing in China, or they get components, and they told us already that certain inventory they're going to be lacking because they're not making any deliveries because no one's working in factories in certain parts of China. And that means that either sales are going to go down because they don't have parts, or they're going to have to go to the second source supplier, which is a lot more expensive. So the revenues are going to be hit, and they're already telling us this as, to adjust our expectations for the budget for 2020. And I don't think the public markets have that already built in. So I don't know if it's going to last for, hopefully, God willing, it only lasts for a couple of days or weeks. But as that gets extended, it's going to have a significant impact on corporate America as well as worldwide business. So it's something that I think we got a little concerned, and we're discussing it now with our portfolio companies to see what we could do to sort of avoid the adverse effects of that.
Tomer, you've got different stakeholders to deal with, right? You've got employees in your company. So every now and then you see this subculture of companies coming out and saying that they're going to be completely transparent about valuation and liquidation preferences so that the employees effectively know the true value of their options. Is that a position that you've either taken in the past or that you've endorsed?
Not sure that I've ever heard about that.
So let me ask the question more bluntly. Do your employees know the value of their own options in the company?
I think that most of them don't.
Don't?
Yeah. Typically, more senior management members ask that as part of their onboarding and negotiation. Most employees never get to that. That's my experience.
And Adam, what do you see about that? How do you feel?
A lot depends on where you are, which city. Because in California, everyone cares about options and everyone knows exactly how much they're worth because for decades, their neighbors, their cousins, their sister, them, everyone they know has made tremendous wealth from stock options. So it's kind of viewed as real income. One of the issues with the first 20 years of the internet venture in Europe, going back from the mid-90s to even 5 or 10 years ago, was no one knew anyone that made real money from stock options. So people just kind of ignore it. They say, okay, that's potentially some bonus that may or may not come, but I'm not going to bank on it. But now that there's more and more success, people care about it more and more. In Israel, for sure, just has an incredible pipeline of very, very valuable companies that are going to create a lot of wealth, not just for the investors and the founders, but also for employees. And the more that happens, the more people care about it and the more precise they want to be. What we see with a lot of our companies is they actually are demystifying it for employees. So giving them like tools so they can understand exactly what the options are worth. And you see that a lot more in the US. I'm actually not as sure like what the state of play is in Israel, but just expect, the trend is people will care more and more and more as there's more success.
I could tell you, I mean, for our companies, again, since they're more mature, people are expecting an exit, and they know that if we're coming in, we obviously want to have an exit. We're not going to hold the company forever. I mean, we consider ourselves long-term investors. We're not just flipping. We want to build the fundamentals of a company, but within 5 to 10 years, hopefully there'll be an exit. So we like to align the interests, and we like to give options to our senior executives and mid-level management to make sure that our interests are aligned and that if we succeed, they succeed. And we did have to explain to some companies what it means. Others are like, I don't need options, I just want a bonus. I want it guaranteed, until we explain to them that your options can be worth a lot more than your annual salary. If you help build a company, this can be incredible for you. And when they realize the potential value, it means a lot to them. And I think it also helps them sort of think about the bigger picture. It's not just, I perform well, I get X. It's more, we're in this together. Let's build this together. So I think that's
it's not just the employee. It's like does their spouse or their mother give them credit for the options or not? It's always more complicated than you think.
You're speaking all in terms of principles, what you seek to achieve when you're looking at companies. I think you've all arrived at all of these principles through your own misadventures or success stories of your own. So as this panel's coming to a close, I'd be interested, you can choose whether you'd like to, for each of you, either a success story on the validation side or a lesson learned for our esteemed audience today. So Yuda, we'll begin with you.
So first of all, again, just to relate to the question that you asked before about option, whatever, it's our responsibility, again, to align. So we always increase the option pool, whatever you try to do. It doesn't matter if you understand or not. You got to do it right and align it in general, because we are into it. Again, I spoke about it yesterday. We are later stage. So for us to go to zero is kind of not an option in a way, because we are really, we have small amount of companies, that each company is very important, and we lean in and we really put a lot of resources and we help companies to achieve goals. And if we have to sell the company, we sell the company, but we rarely lose money. I mean, maybe we don't do it 3 or 4 times our investment, but we basically sell the company. Early stage, a different model, and basically you can lose more money because that's the model. So I cannot recall that we went to below our capital. And we have great success, which is, what we strive to, because we are really focusing on the company that we invest, because it's a small amount.
So we've been around for close to 16 years. As opposed to venture capital, we invest in maybe 3 deals a year. And after selling companies, we have about 36 companies in the portfolio now, but over the 16 years, we've only written off 1 company, thank God. And that's because we're so conservative, so we might have missed some home runs, but at least we're getting the doubles and triples. But just one lesson learned early on, I think it was the second year that we were around, we made an investment in a company, and as I mentioned, we like to draw the line of like $10 million in revenue to show it's not a startup. And one company we met with, heard that, and then they came to us later on and they said, no problem, we have a run rate of $10 million. And it's a great product, and it's innovative, and it's something you love, and so on. So we met the company, met the founder, we did our diligence. We had top-notch, one of the big 4 due diligence. We had one of the top law firms in Israel due diligence. We did diligence, everything, made calls to customers. And we made the investment. We brought in a new CEO, also a really sharp guy. And after a month, he came to us and said, guys, I don't know what they sold you here. And by the way, he was doing diligence with us, so I like the way he did that. But he goes, I know they sold you here, but the revenues are not the revenues. The product needs at least a $10 million investment in order to get it to market, even though it's being sold. There's a lot of problems and issues. And we said, what do you mean the revenues aren't the revenues? So he said, well, they actually were doing what's called stuffing the channels, meaning they went to all their existing customers and said, hey, we'll give you like a 50% discount if you just buy like all the, everything you need and all these machines that you're going to think of buying over the next 2 years if you buy it now. So on paper, they had all these sales, and when we spoke to these customers, they were very happy, and they didn't tell us that they weren't going to be buying. So the pipeline that they had, suddenly the CEO's there, and he's like, I have 0 sales for the next quarter. And we're like, how could that be? They're on a $10 million run rate. It can't be. And thank God we had staged the investment. So at that point, we only invested $3 million. So we basically wrote it off, and we were, utterly embarrassed. We sent a letter to all our limited partners, and we got phone calls from almost every one of them saying, congratulations, we appreciate what you did. And we're like, why? They said, because it's easy to put bad money after good money. We easily could have hit it and made the next investment, then put another 10 million, raised around, whatever. We would have gotten through maybe the next 6 months to 12 months. And who knows? We think about it today. Maybe 2-3 years down the line, the company would have been good. But we just said, these are going to be our partners. We don't trust them because we weren't buying 100% of the company. So we just sort of cut our losses, and we're glad we did. And we're a lot more careful in the diligence now, from lessons that we've learned there.
So I'll speak to the founders and the entrepreneurs. I think the probably one of the best tips that I could give is regarding valuation is just try to avoid it if it becomes an issue. And for that, of course, they have a CLA, which is a great tool in order to say, hey, well, let's not establish a valuation now. You guys want to invest, we want you to come in. But we'll essentially, set the valuation based on the next round. So it will be established by a new investor sometime down the road. I also want to say that there's a lot of room to be creative. For example, you can set a certain valuation and then, based on milestones, that can change afterwards by allocating additional stock and so forth. So there's a lot of room for creativity. Do not get fixated on this. It's just not worth delaying deals over this issue.
Yeah, so so lessons learned. One of my partners, Joel Cutler, who is one of the founders of our firm, he jokes that when you overpay for high quality, it only hurts once, very briefly, at the time of the investment. But when you get a really good deal on poor quality, it hurts you every day for 10 years, right? So that is a little bit of the reality of the world we live in. And when I think about some of our best investments, like Stripe, Airbnb, Snap, Lemonade in Israel, Fiverr in Israel for my past, Rapid, which we made recently. At the time, we massively overpaid for all of these companies, but we wouldn't have got in if we didn't, and they turned out to be really good investments. On the flip side, I have a number of investments in really high-quality companies where I did overpay to get in because there were highly competitive deals at the early stages, like Series A, especially Series B rounds. And the companies have done well and could be 10 or 20 or 30 times the size in revenue, but actually from a markup perspective, they're very modest. Because in addition to having overpaid, there's also the reality of dilution for further funding rounds and options and everything else. So the summary is, for our really good companies, we've generally overpaid for all of them. Some of them we look like geniuses, and some of them will just be okay investments because we overpaid. So you always kind of walk in the tightrope and trying to figure out how to do this as well as you can, and it's very challenging. That's why I don't have any hair, and I'm gray.
So I think that's it, right? I want to thank our very lively and engaging panel for showing us a host of ideas. And for showing that, yes, valuation is determined by multiples and mathematical calculations, but it's equal parts art and science. And the art is really where the most interesting discussion lies. And I think as active investors, as the valuation question is one you keep revisiting throughout the life of your investment. You don't just make it once. You keep checking whether it makes sense as you continue to infuse capital into a growing company. But I think that it's a nice lesson for humility, that while it's a tool, it's one of several tools, and that you should diversify the tools in your toolkit to look at it as an indicator, albeit elusive, but also to make sure that you have robust information rights and board presence so that you maintain that transparency so you can calibrate your guidance accordingly. So thank you very much. I wish you all much, much luck in all your investments going forward. Thank you very much.